The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
So we've had a bunch of volatility this past week, actually the past several weeks. And our expectation is that as we move now between now and the election, this volatility is not going to go away. Presidential elections typically have volatility associated in the market. This time of year typically has increasing volatility. Most of you are probably familiar with the adage, sell in May and go away, you buy in October after the next crash has occurred. And that's kind of the period we're in. So we kind of expect that there's just an awful lot of uncertainty given global economics, domestic economics, and politics both here and abroad. This last Tuesday, stocks posted their worst day since August 5th when we had a market meltdown. And the S&P fell more than 2%. So it's one of those exception days. Growth and monetary anxieties combined to just basically set fire to risky assets as much as they did a month ago when we had the yen carry trade collapse. That was a high risk bet that big money investors, high frequency funds, traders were using. But with the S&P and the NASDAQ seeing the worst starts to a September since 2015 and 2002, anxiety increases. Basically, inflation expectations seem to be pretty well anchored. In fact, in this month's end of webinar survey, I didn't ask any questions about inflation, because there just aren't any surveys showing that people are worried about it anymore. It's not that it's gone away, but whether or not it's likely to go substantially higher has, it's just left the studio. But we do have concerns about the health of the economy. We see weakness showing up. The ISM report came in, the labor report came in. We've got a couple of labor reports that came through this week. And while it's basically, there's good news, bad news, and which one do you want to look at? Traders are still anticipating the Fed is going to reduce rates by more than 2 full percentage points over the next 12 months. And that would be the steepest drop outside of a downturn since 1980s. There are modest signals this week in the job report that would be a key decision for whether the Fed takes a cautious or an aggressive approach. And we're going to find that out on the 18th when the FOMC meeting concludes and Chair Powell makes his summary speech and does Q&A. One of the big concerns has been that the yield curve is disinverting or uninverting. So this is the difference between the 2 and the 10-year maturities. And typically, when it uninverts, we're heading into a recession. The Fed is becoming more concerned about maintaining economic growth. They have 2 jobs. One is to maintain economic stability and stability in the labor market. Not that they can really do much about either one. They don't control the jobs. And currently in the current environment, with the Fed, with the Congress spending money at record levels and planning on spending even more without any fiscal responsibility, that's been the inflation driver, and the Fed can't do enough to unwind it. But we're sitting here looking at this uninverted yield curve ending a 26-month long period of time from here to here. This is a significantly long period. And we are post-COVID with global central bank and government interventions into the marketplace which skews all historic data. It makes it very difficult to take an assumption that has worked in the past and apply it to today's environment with a high degree of certainty. There just is no high degree of certainty in any longer term signal. And what we have when we take a look at this is what we can see is where the uninversion or disinversion occurred, and then we had a recession that's in the gray bars, and then we have 287 days, another uninversion, and another recession, another inversion. It took a while here before this one was reported. Rates came down. This is the 2008 and 9 recession right in here. We get this brief inverted and then uninverted, and a brief recession associated with COVID. The largesse of pumping money into the economy, causing inflation, not trying to deal with that. And then now here we are with an uninversion. So these shaded circles highlight the last 4 times the yield curve was inverted and uninverted. And each time the yield curve inverted and uninverted, the recession was there. The numbers next to the shaded circles are the days between uninversion and the start of the next one. That's determined by the NBR. But they always wait almost a year before they say, well, we were in a recession. At which point you have to say, and so what good does that do me now? I mean, we should have figured this out earlier, but government reports are often late anyway. So you have to look at what you can and make decisions based on the data that you're able to collect yourself. This time it does look like we have some time to prepare. As we take a look at this table, I went 2 clicks behind there. There we go. So if we stress if the economy is heading for a recession and the S&P is ultimately setting up for a drawdown, which is typical recessions, then we have to understand that we should at least pay attention to this warning. One of which is the Somm rule, and Claudia Somm, who created that rule, has said this time around, because of the mess we have with COVID intervention, not too sure my rule is good this time around. So we don't even have consistent returns for the S&P 500 following an uninversion. I mean, certainly here the tech bubble was just a disastrous return and took almost 3 years to bottom in the market, and then I think the tech index, NASDAQ, took about 13 years just to break even for that. So these are periods of time that we have some concerns, but we have to adapt to what we see that is in front of us. The key lesson from the last few weeks is that big tech stocks are no longer defensive. I mean, it is for the last several years because of the massive leadership in the Magnificent Seven. Many people on the internet, blogging or in social media, have said your defense in this economy is just buy big tech. Large cap tech stocks, that's all you need. You don't worry about anything. Well, except for the last several weeks, I found that meme was certainly not true. There is, well, there's actually little evidence right now of a slowdown in spending on artificial intelligence. The assumptions about how profitable it's going to be have been very high, escalated, exuberant. And investors seem to be concerned now for if you're going to spend all this money, are you actually going to make any profits? And profits are a concern. The assumption here is that the Fed is going to make some really deep cuts over the next 12 months, particularly on the high end of the expectations is that we're going to see a full 2 percentage point reduction in the Federal Reserve's basic rates, which would be the steepest drop outside of an economic recession that we've had since the 1980s. So we're basically playing with the probability of the job market stabilizing or just deteriorating really rapidly. Which one is it going to be? That's the debate right now for the rest of the year. And the key lesson of the last few weeks is that big stocks are not a proven defensive strategy during market pullbacks. There's little evidence of a slowing down in artificial intelligence spending, what in the business is called CapEx, capital expenditure to build a business for tomorrow. Valuations have been extended, to say the least, and that's impacted corporate and macro data. And the big behemoth in that, of course, has been NVIDIA. So here's a copy of our photo of NVIDIA's headquarters, and they've taken some really big hits lately, not because they're not making money and not because they're not the dominant player in generating chips. I mean, if we just go back a few years, I mean, their business was game chips. And the fact that they're now doing AI was, they were in the right place at the right time. And somebody said, well, look at that. This will work over here. And they kind of made a little bit of internal shift, and they dominated the global market, and they are way ahead of everybody else. So they are still going to be in business, but what's upset the market is that they said business is slowing down. We're not going to see the same amount of sales. Profit margin is still going to be really strong. But when you take a look at a company like Amazon or Microsoft and you look at their list of customers, it's a very long list. You look at NVIDIA's customers and where they get the vast majority, and I'm not talking about 51%, I'm talking closer to 80% or sometimes even more. They get that business from 10 companies. That's part of the risk and disappointment when they say, we don't expect quite as much in the next year or two as we have the last couple of years. Investors said, well, the game's over. Well, the game's not over. I mean, it's just like it's not over for these other companies that dominate the NASDAQ 100. NVIDIA is the fourth heaviestly weighted stock in the NASDAQ 100. And the weighting, this weighting is well, the next one I have is actually the S&P 500. So here we are with NVIDIA, and here's S&P 500. It's in the same position. It's the fourth most dominant stock, and it's not going away. But the S&P tends to track the NASDAQ indexes very closely. More so than the Dow, because the Dow doesn't have Amazon, NVIDIA, Google, Meta, or Tesla in it. But when some bad news happens, well, let's not call it bad news. It was a more realistic assumption about the future for NVIDIA. Investors said, well, maybe we shouldn't be here anymore, and they started rotating to other stocks. But if we take a look at what actually happened with NVIDIA, from its high back here in late June to where it closed, and actually this is the close on Thursday, right there, it's down 21%. Well, being the fourth biggest stock in both the NASDAQ and the S&P, that's going to impact those indexes. The news media reports on the indexes, a 21% decline. That's bear market territory. The world is coming to an end. You've got to be prepared for a lot of bad news. Now, it didn't help that some of the other Magnificent Seven are also struggling. Apple, not so much. Tesla's an on again, off again deal. Google's got more litigation going with it. So there's been some accumulation of bad news. But let's take a look here. When we take a look at actually what NVIDIA said, they announced that the Department of Justice subpoenaed them for some information. It was reported that they're being subpoenaed, and it was implied that means that DOJ is going after them. But actually, NVIDIA said, we didn't get a subpoena. We got a request for more information, which we actually got months ago and reported then, and we've been giving them the information that they're taking a look at. NVIDIA was acquiring a company called Run AI, and DOJ's concern is that it would be anti-competitive in the marketplace. And the CEO of Taiwan Semiconductor told Bloomberg TV that the Department of Justice does not understand the demand for AI chips or understand the expected industry growth that is significantly above the 20-year trend. BlackRock and Goldman Sachs are still committed to the Magnificent Seven techs based on the valuations that they see or the way they calculate them. And the current dominant companies are much more profitable and have stronger balance sheets than those that dominated during the tech bubble. Artificial intelligence is not dead. Asking when investing AI will be profitable is uncertain. But so some of these numbers can be small and they're difficult to read. So I blew up a couple. So the current averages of the Magnificent Seven, their market weight today is larger than back in 2000. However, the amount of cash they have as reserves as a percent of their market capitalization is more than double what was existing back in 2000. Now their net debt to equity is 30% minus 4 as opposed to 4, but the return on equity is 46% versus 28, and the net income margin that they have is 28% to 16. These are much more stable companies, and they don't have artificial.com web pages as their business model. Their business model generates real product and real profit. So we have a little uncertainty regarding the return on capital expenditure for integrating AI into their business, but they're not going out of business. So the market sell-off is a normal psychological adjustment to investor reaction to headlines rather than dig down into the numbers reality event. In the beginning of summer, Mr. Market began expecting larger rate cuts than we currently have had, and it looks like larger than we're going to get right away. And that would reduce interest costs, and as a result, it should cause small cap and medium cap companies to do better because they're heavily dependent on borrowing, and interest rate expense would follow. But what we have a look here is one of the things we do every week is review whether we should be in investment A or investment B. And one of this particular chart is Russell Small Cap 2000 versus the S&P 500 ETFs. When the line is falling, when the trend is going down, it means that the second ticker is the higher performance ticker. And we've had some areas where small cap rallied back here in the end of 23. The last quarter, it looked like there was the rotation into small cap was the place to be, and money moved, but that didn't last, and it failed. Here last month, or well, actually at beginning of July, we got another one of those rallies of rotation into small cap over fear that the Magnificent Seven was never going to be what it has been. But that's also failed, and we're back in an environment where the safety of large cap stocks is actually the better economic bet. Whether or not rates will come down fast enough to keep 40% of small companies that are on the verge of bankruptcy from going bankrupt is uncertain. July, we saw a sharp shift toward that smaller cap investment, and investors left the mega caps. They said, well, the domination of mega 7 is over. But then the poor results for NVIDIA can be argued that it might be positive for the market, as it would release capital for other investment opportunities, for other businesses. That just hasn't happened. Russell 2000 index of small cap companies down 3.1%, and the Magnificent Seven was down 3.35. That's not significant rotation. Now, a recession is actually bad news for small caps, because interest rates may come down and reduce their interest expense, but sales dry up. That's not good, because it means they won't be able to make the payment anyway, even with a lower rate of interest. And what we find with these rallies in small cap stocks is that we're really in a big trading range. We go back here to the all-time high in the fourth quarter of 21, and we can see that we got this fall, this drop that came in the aftermath of that peak, which affected the whole market. 22 was a tough year with a lot of whipsaw activity in it. But here's the small cap index, and it's basically in a very big trading range. Rally and fail, rally and fail, rally and fail, rally and fail, rally and fail once again. And it forces us to remember that we need to have perspective on what's going on within the market. And as Perry mentioned earlier, sometimes it takes a long time to get even. If we go back and take a look at the tech bubble, get a line here. From this peak back here, actually the peak is the first quarter of, that was March of 2000. And we run across here in a straight line, actually full recovery for buy and hold investors is about 13 years. Well, it is. Here we are in the beginning of 2000, and here we are in the beginning of 13. I think that's 13 years. We can calculate some months, but that's a long time to get even while markets go up and down. And that's really what we're seeing in the small cap area. We just really haven't had enough rotation to give that a great deal of strength. That doesn't mean pieces of the small cap area aren't available to hold, but they are simply not a good, have not been a good buy and hold strategy for a while. The 08 market, that would be from here, was a little shorter recovery. That was about 7 years, 6.5, 7 years, because this actually topped out in the summer. Well, this is the S&P, so this is summer of 06, and here we are again in 13. If we take a look at some other indexes, it topped out in 07 and got even in 13. But these are some significant time periods, and our management proposition is these drawdowns that occur through here when you're looking at a 57% drawdown and you're waiting all these years, it even doesn't make any sense. So our rotation activity is driven by recent returns, shorter time period returns, to rotate into strength and to eliminate things that are not doing us any good. Either we need to preserve capital or find another asset class or alternative for leadership to move forward. Change my cursor and get back to the screen. So here's the small cap index, IWM, Russell 2000 index. 5-day returns down 2.5, 10 days is down 1.6. Year-to-date change is about 5.5. This was as of Thursday's close, so it's probably down closer to 4 year-to-date at this point in time. The short-term reason for being short in September is seasonality, and this is the buy in May and go away and get through this period of time before things really happen. Since 1928, the S&P, SPX being the S&P 500, has been up between 10 and 22%, 27 out of 30 times from September to December. So this time period where we get these drawdowns typically is associated with seasonal uncertainty, as we see with elections, because we have elections of some sort every other year in September, November, and then the election campaign period. And then we get the fourth quarter where big institutional money is preparing for next year. Now, why can't we do that? Well, big institutional money, they're big, which means they can call up the CEO of any company they want to and say, we're going to send analysts over and we want to talk to the chief financial officer, we want to talk to you, CEO, and we want a complete tour of your facilities with freedom to discuss with your managers what's going on. You and I don't get to do that. So we don't have that same long-term view, which is a 3 to 5 year view that mutual fund managers and large family offices and high frequency traders who are managing billions of money, they get to do that and make assumptions about where these things are going to be. We have to deal with this uncertainty. But when we look at this last year-end move in the market, the biggest loss since 1928 in the 5 months of September through December, the biggest loss is only 4.25%. So we have to use process to get through the emotional response to volatility. This volatility is what kind of messes with our brains. Now, do we have some justification for market trading down a little bit right now? And that is, yeah, because more than 91% of the S&P 500 stocks are above their 20-day moving average, which is a significant level of support. And that's the highest it has been since November of 22. We get up to these levels, as you can see with this, we call it a resistance line. I mean, we get up here and trying to get 100% of the companies above their 20-day moving average is just not statistically probable. What is probable is we'll get some drawdown. They won't all be this steep, but down into this range, yeah, in here, that's a little bit more reasonable expectation. But every time we are short the overall market, we have to remind ourselves that the buy the dip investor is a feature and a process that's been strong for decades. We can see that since this actually goes back to 1988-99. People have decided, rightly or wrongly, that when the market sells off, that's when to put money in. Well, that's true. You get a cheaper buy as long as you have some idea of what you're buying. The issue is buy the dippers are still present in the market. And the fact that NVIDIA and the AI issue are on the front headlines is not a justification for expecting buy the dip activity to disappear. Typically, we have strong October to December movement in the market. This shows money flowing into the market in the fourth quarter of the year. This is the percentage of assets under management by year end. So some of this is people who subscribe to sell in May and go away, buy in October, and the money comes back in. Some of it is deferred money that has been built up in summer sales and bonuses or whatever, and they want to get invested. Some of it are people who have ignored the market and suddenly say, I'm not getting enough in my cash. I've missed out on returns because I wasn't invested. I was fearful and it was unjustified. So the money piles back in. We still have more than $6 trillion of cash, which is earning, well, now it's earning a little less than 5% in money market funds. And about a third of that money is owned by retail investors. So this actually tracks retail investors, institutional investors, and this is the total assets that are basically in cash. Assuming the Fed does cut interest rates later this month and probably again very likely again in December and continues that into next year, those money market returns are going to dissipate very quickly, and all of a sudden being invested in the money market fund that's no longer paying 5 but is paying 2, people are going to probably say, you know, maybe I should go ahead and return to the market. The other thing that is actually supportive is that the S&P 500, despite the volatility we've had of recent, has been generating reasonably improved earnings. President Trump's promise to cut the federal corporate tax rate to 15% from 21% is expected to raise earnings for the S&P 500 on average by about 4%, according to some analysts. Alternatively, if Vice President Harris's proposal to lift the rate to 28% would reduce earnings by about 5%. That, however, is not something that is being told to the broad sector of American voters. These sensitivities only reflect the direct impact of changing tax policy. They do not take into account the secondary impacts, such as changes in economic activity. An alternative view of President Trump's proposals on tariffs is that it will destroy the American economy and it will raise inflation. But if we look back at what actually he did in his first term, his only term as president with tariffs, is he used them as a really big bargaining chip. For instance, what comes to mind is he did not like the tariffs that France was applying to US products. And he called Macron and said, you get rid of those tariffs because this isn't fair. And Macron said, we can't do that. I don't have a French accent, so I'm not going to pretend. And President Trump then said, well, okay, we're going to tax all of your wine at 100%. And Macron said, well, we can't do that. I said, okay, you get 100% tax as of tomorrow on all of French wine coming in the United States. A couple hours later, Macron called back and said, tariffs are gone. Tariffs are gone. We're okay. I mean, we've got an open playground here to trade equally fair. So I'm not concerned, Perry's not concerned about the tariff fear that has been put out by a lot of the mainstream media. Let's get back to prediction. The prediction markets show there's a substantial probability that whoever's president, Congress is still likely to be split, and it's going to make it difficult for either one of them to implement their campaign proposals or promises, because campaign proposals just simply do not always translate into legislative activity. And all of these add up to the reasons why we no longer use the 1951 theory of being broadly diversified and holding for very long periods of time, because the very long periods of time generally are longer than our lifetimes, and we don't have our lifetime to invest. We only have our later years in life to invest. So we use the process of rotation. And last month, this is a slide that we showed you where we were positioned in our three primary models. As of Friday's close, this is where we are now. They have all been updated to current leadership. The dynamic model is the only one that we will take an inverse position by using an exchange traded fund. So we have a 25% short the market position, not because we think there's a bear market looming. It's just simply a hedge for the other assets that we have in the portfolio. We're not in the prediction business. We have no idea what the market holds between now and the end of the year, other than probabilities, which we've tried to outline are still upward and onward, with a whole bunch of uncertainty between a period of returning trend dynamics. So we're in the interpretation business, not the prediction business. And what we do is not something that's intended for slackers. When slackers take a buy and hold position, they like the company and they don't care whether there's good news or bad news. Which, if we go back to the tech bubble and you look at one of the leading companies, which was Intel, and you were a buy and hold believer in the web and the chip business, you would be substantially underperforming for the last 25 years holding Intel. And we just don't think that's good investment policy. Someone needs to pay attention to what's actually going on with the positions in your portfolio. You need to worry about them, and you want to invest and not worry, but that's not reality. You need to watch them, but you got a job, family, vacation, kids, transition in life as they go to college. All of those things are distraction, but if you're going to manage your portfolio, you have to commit regular time, establish rules, and follow the rules. If you don't want to do that, that's why we have a business. You can hire us. You can send us questions. You can ask for help. Here's an email address to do that. You want to talk to us directly, here's our phone number. We do regular updates on our podcast at YouTube. You can find them on our website. We just recently updated it, so it's easier to find the podcast and to find replays of our webinars.